Hello, Victor. Thank you for coming today. The first question that I would like to ask is how and you got acquainted with financial modeling. Could you please tell us a bit more?
Hello, thanks for calling me. Of course, when I was studying at the economic faculty of GIMO, I had some courses on discounted cash flows and financial mathematics, but they were mainly theoretical. I also had a course on financial modeling, which included even some Excel, but it was rather short. So I primarily got acquainted with financial modeling when I started my career in valuation business modeling department of EY, and it was practical from the very start.
Mm-hmm. Okay, thank you. And how did your career develop further? How was it connected with financial modeling?
Well, after 3 years in EY, I worked for various M&A and private equity companies, as well as family offices, and somehow it was always connected with financial modeling, more or less. Now I'm head of M&A in DLab, which is one of the leaders of the corporate market in laboratory diagnostics in Russia. And I cannot say that I am busy with financial modeling each day, but usually when determining the offering price, for example, for a potential target, I usually make a small DCF, and it helps me to determine the potential payback period or make some stress tests.
Okay, and so what is your overall experience of financial modeling?
Well, I cannot say I ever counted, but throughout 14 years of my career, I developed from scratch several dozens of financial models. And they varied a lot in terms of complexity, from simple one-sheet DCFs to like tremendous spreadsheets with thousands of rows of formulas. And they covered many different industries like telecoms, metals and mining, machinery, retail, FMCG, etc.
Okay, it sounds like you are really an expert in this sphere. And but what's then advice? What kind of advice could you give, for instance, to entry-level specialists who just start getting acquainted with financial modeling?
Yes, I have some general advice. The first thing is pay less attention to Excel itself. Like many models, focus on formulas and sophisticated algorithms and try to make a model automatically updatable. But in my opinion, the first thing one should do while developing a financial model is understanding the essence of the business of the company, of the underlying company. In fact, in EY, we had a saying, sorry for some slang, which is shit in, shit out. This means that if you make wrong assumptions for the model, you will inevitably get useless results, no matter how perfect your model is in terms of calculations. And this idea leads us to another one, which is there can be no universal template for a model. Because if you think of it, you can possibly think of no Excel spreadsheet which would work equally well for a hotel or a telecom company or a machine building plant. And of course, that's the reason why I usually develop all my models from scratch. Of course, I have some small template, but it's just a couple of sheets with general structure and some macroeconomic indicators like price indices or exchange rates. And the third general advice is the thing that a financial model is not a budget. So don't try to make it too detailed. I had a negative experience of this kind when one of the clients even forced me to integrate the full full staff schedule into a model. And the fact is that it was pretty useless because 95% of salaries were still forecasted using one and the same price index. So you won't get any more accuracy in results, just make a model more complex and to develop and then to review.
Okay, yeah. So thank you for your advice. And maybe there are some small tricks that you would recommend using. Maybe you have already used.
Yes, I have such kind of tricks. The first one is color mapping, and it gives a lot in terms of accuracy and review. In a financial model, you usually have different kinds of data like inputs, links, formulas, choices, matrices, and you could choose different colors for each of them and fill in all the cells depending on the type of data. You could even pick some 2 or 3 adjacent tones of one color for each data type, because it often happens that formula or a data source changes in the middle of a row, so you could easily notice it. And the second trick, which might seem quite simple and unimportant, but also helps in reviewing the model and avoiding mistakes, is the thing that you could, if you have several sheets in a model, make sure that time periods, the same time periods are placed in the same columns on each sheet. So even if you hit the wrong cell while writing a formula, you can easily notice it.
Okay. I see that you pay pretty much attention to reviewing models and avoiding mistakes. I think it was like your hint, your advice.
Yeah, because however accurate, any person is not insured from like hitting the wrong cell or hitting the wrong key on keyboard, and especially when you're busy with the model for a third or fourth day in a row. So after finishing, you should always do a review, and there are 2 aspects of review. The first one is self-review, and it could be done by getting a general picture on the results you have, especially on the final P&L or cash flow statement, and you should be able to explain the results in plain words, like you're explaining them to your client or to your higher colleague. And if you cannot do that, you should pay attention to it. Maybe you have some mistake in there. And one more method of reviewing is making a balance sheet. Usually it is omitted from valuation models, but it can be helpful because it connects the results of P&L and cash flows, and if there's some mistake, you simply won't be able to balance it. And the first aspect is a third-party review. And before releasing the model, you should always try to have someone like a colleague or a friend to have a look at the model. And because when you develop a model, you usually get this tunnel view and can easily miss even evident things which a third party could easily notice.
Okay, yeah. Thank you, Victor. I think it was really very informative for our students. Thank you for coming today.
Hope it will help. Thank you. Thanks. Bye. Hello everyone, my name is Victor, and today I will tell you a couple of things about a hotel financial model. In fact, this is a real model of a real 5-star hotel in St. Petersburg, which I developed as far as in 2012. Nevertheless, it is still, I guess, up to date. Well, I guess it's no use explaining the model in every detail, because if you have an Excel in hand, you can easily go through all the formulas and links and understand the connections between indicators and understand the logic of a model. And I wanted to emphasize two things that are a bit specific to the hotel business. The first one is the license fees, which you can find in expenses. What is the license fees? You may know that a hotel is usually run by an operator. I guess everyone knows these famous names of hotel chains like Four Seasons or Hyatt or whatever. Even Holiday Inn, though it's only 3 stars. Nevertheless, all these hotel chains are run by global operators. And in fact, there's a difference between an owner of the hotel and an operator. An owner just owns the building. And an owner usually has a contract with an operator and an operator runs the property. An operator usually appoints a general manager who then hires the staff, develops a budget, and runs all day-to-day business. And an owner just approves of the budget and then gets the profit, or a loss. Well, so an operator gets a reward for its services in the form of license fees. They are usually specified in a contract, and there might be different kinds of fees like consulting, royalty, like you can see in the model like stimulating fees, and so on and so forth. They might be specified as a percentage of revenue or any kind of profit or cash flow, even a cash flow. So, in order to forecast the expenses properly, you should thoroughly study the contract between an owner and an operator and get all the details of these license fees and then forecast them. Of course, this is not an only kind of running a business. There might be no operator. especially for some small privately owned hotels. In this case, you won't have this item in expenses. And I even had one case in my experience when a hotel had a franchising agreement with an operator. So it used a brand, but didn't use operating services. So the hotel paid just some franchise payments as a percentage of revenue, and that's it. But it's a rather rare case. And the second one, second quite interesting thing is the trophy asset premium. It's not quite often in the hotel business, but sometimes it happens, and you might be interested in what it is. In fact, a trophy asset is a notion from the real estate business in general and hotel business in particular. A trophy asset is a kind of property which is can be distinguished for some of its features. For example, it can be situated in some historical building, or might have some history, or might have a premium location, or a distinguished operator, or in fact all of these factors at once. And what is the connection between trophy asset and valuation? In fact, investors prefer these trophy assets because they are free from, their price is generally free from fluctuations in any market conditions. So their price usually goes up and almost never goes down. So the investors might be ready for lower current returns because they know that they will get their returns like in some years when selling this object. This means that the actual market price might be higher than the sum of discounted cash flows. And this premium may go as high as 30% or even 40 or even 50%. This is a bit tricky when determining what this premium should be. And it's kind of like the best guess you could make depending on the qualities of an object. But you could also like Google something and might even find some advice on the matter. So I guess these are the two most interesting things you could find in this model, but feel free to study it thoroughly and understand the business and the model, how it's developed, and you can also see in it all the examples of all the advice I made in my interview. Thanks for your attention. Hope you'll find it interesting. Bye-bye.
Hello, Roman. Thank you for coming today. Could you tell us a bit your experience, your expertise?
Sure, and thanks for the opportunity. So education-wise, I'm a graduate of the Higher School of Economics almost 14 years ago. That was class 2007. Then I did New Economics School, Masters in Economics 2008. I did my Candidate of Science work 2010, and I also got my MBA from MIT Sloan in 2013. So quite a bit of an academic background, although I spent most of my career outside of the academics. I worked for Morgan Stanley in New York as an associate. I also did work for McKinsey in Russia and in a few other countries. And my last job, I was a CEO of a large agriculture company.
Yeah, thank you, Roman. Sounds really great. And so the main topic of our course is financial modeling. Do you think that it's still really important nowadays?
I think so. And I think that with my experience, almost every serious corporate decision, whether it's investment or operations or a certain transaction, that would involve a financial model of a kind. And there would always be a guy in the company who would be responsible for building the model, checking the model, and then interpreting the outcomes of the model.
Mm-hmm. Okay. So we see that you have many years of experience in investment banking and in management consulting. Is financial modeling also important in these spheres as well?
Yeah, absolutely. I would say at the early stage of the career is almost the bread and butter of the profession. Mm-hmm. And in Morgan Stanley, I would say I would be dealing with the financial models daily and nightly sometimes, because the working hours were pretty long. With management consulting, as an analyst, as an associate, you also oftentimes do the financial models. You either build them from scratch on your own, or you guide someone who is building the model for you. But that's clearly a very important aspect of the job.
Okay, and did you have any cases in your career and in your job experience, work experience, when a model was like the core, the main thing in your job?
Yeah, multiple times. So I would say in Morgan Stanley, especially at the early tenures, that was clearly the main product or one of the main products that an analyst would provide to the senior team. So of course that was basically the job. And then with the firm, it depends on the project, but there were certain cases where the financial model would be pivotal to a certain case, and the intuitive decision might have been changed or altered because of the outcomes of the model.
Mm-hmm. Okay, I see. Okay, and what industries did you have a chance to cover in your career? Are the models different in different industries?
Mm-hmm. I think I was lucky to have a fairly broad exposure to different industries. So obviously the last one was agriculture, but early in the career I was covering pharmaceuticals, I was covering metals and mining, and I did quite a bunch of work in financial institutions. So I would say the models are different, and the models are different depending on what are you trying to model. Like there is a set of financial models that you use in investment banking. There are some other types of models that you use to model a certain capital-intensive project or a certain investment. However, the principles that sit behind the model are fairly similar. One thing I should say, probably the financial institutions are somewhat very different from in modeling versus what you do in industrial companies. However, eventually you all come to some sort of free cash flow statement, and then the valuation methodology is relatively similar.
Mm-hmm. Okay, fine. And what we see right now, the world is really changing pretty fast. COVID brought some unpredictability, and is this really possible to forecast the future using a model?
Well, it's a great question. I think with the COVID, with the growing uncertainty, the aspect of financial modeling in business becomes increasingly important. It's impossible to predict the future, but it's very possible to construct different scenarios of the future. And the more uncertainty you have, the more useful is the financial model, because it can help you answer, if this and this happens, then what would be the outcome? If you change a certain condition, what would be the outcome, right? There are also a lot of sensitivities that you can build into financial models, and there is a way to do so. And with that, it also helps you calibrate the importance of certain factors versus the others. And that helps you make better and more informed decisions.
Okay. So forecasting is really difficult, as I see. Yeah. So Roman, thank you. It was really interesting. And what would you recommend for those people who just start getting acquainted with financial modeling?
Oh, a few things. It's a long journey, and it's more of a journey than a destination. So one thing I would definitely recommend: find a guy in the team, find a guy in the organization who's already experienced in financial modeling, and try to team up with him. Having a sort of a more experienced body in financial modeling oftentimes helps. Another thing, just don't be afraid to start. You need to start somewhere, and that's obviously an acquired skill. No one is born to be a financial analyst, and no one is born with the skill to do financial models. Everyone was starting somewhere, sometime, and you're just one of the many in this journey. So just don't be afraid and do that. The third thing, well, if you really want to go deep in financial modeling, and if you feel like that's the passion you have, then choosing a job in finance, investment banking, that's definitely where you will learn how to build good financial models in the first couple of years, whether you want it or not. In my experience, before we even started in Morgan Stanley, in my class of associates, we had a 2-week-long training on basically focused on different financial models that were used in Morgan Stanley in my division, and I found it very helpful. So there are certain classes available out there in the web. I would also recommend using one of those.
Okay, yeah, thank you, Roman, for coming today. It was really interesting talking to you. Yeah.
Good. And then finally, maybe with the financial modeling, it's a bit of an art and a science in itself. There are obviously some core skills, some technical skills that you need to have to be able to do good financial modeling, but there is also some creativity behind that, which may sound a bit counterintuitive, but there is indeed a lot of creativity of how you can do certain things and certain aspects in the model. So I would say just learn the basics, find the guy in the team who is a bit more experienced, watch him, absorb what he does, and then start the game of your own. It's almost like learning to play tennis. There are certain technicalities that you need to learn. If you don't have them, then you won't be able to play, but then it's really the game, and each game is a bit different.
Okay.
Enjoy.
I hope that our guidelines will be really helpful for the students.
Hope so. Good. All right, very good. So guys, I'm gonna walk you through the model of a sample land plot acquisition. Yeah, that's a very common situation in agriculture business. People buy and sell land, and oftentimes you have certain parts of land that you want to evaluate and understand what's going to be the IRR, the discounted payback period, and the NPV of the possible transaction. So how do you do that? Let's model a simple situation. You've got someone who knocked your door and offered a land plot of 100 hectares for purchase. What will you do with that? So the first thing you want to model is your production program. Basically, that's an answer to a question: what are you going to do with the land once it gets yours? And here we start with the crop rotation. The crop rotation mechanism is basically a schedule of different crops that you plant into your land. The idea behind is that you normally don't do crop after crop after crop. You want to rotate them because that's how basically that's how agronomy works. And we can start with a sample model thing: sugar beet, winter wheat, and soy. It's not a very standard crop rotation. You usually don't do sugar beet more often than once in 4 years, but for the sake of the modeling, we can stick with that. And since 100 hectares is a fairly small amount of land, it's usually one field, maybe 2 fields. In Russia, we're just gonna allocate 100% of each crop per year. So let's say year 2022 would be only soy, then year 2023 will be only winter wheat, 2024 only sugar beet, and then you go back to your rotation. You do soy, and then winter wheat, and then soy, and then winter wheat, and then sugar beet again. Something like that. So once you do that, once you establish your crop rotation, that's what you usually discuss with your agronomy team. You need to get to the yields. Yield is basically some sort of a unit economics in agriculture. It's how much of an output do you get from hectare. And we just hard-coded it here. So for sugar beets, that would be 450 centners per hectare, then growing up to 500. For winter wheat, we would start with 50, then we would go it to 56. And for soy, we'll start with 18, and eventually would grow it to 21, 22. The yields, they're usually determined by the type of the land, by the climate zone, by the technology used, by a lot of factors. Here we just made it simple, we hard-coded them, but the yields are fairly reasonable for the central Russian area. So once you have the yields and the crop rotation, you basically know what are you growing each year and what's going to be the amount produced, right? And that's what brings you to the gross product. You simply multiply the yields per hectare times your hectares used per certain crop in a year, and that's what you get. You get that, and the question is, how much do you sell? So for sales, here for simplification, we would use a coefficient that would convert the gross product into the sold product. The coefficient sits a little bit above here. That's called the net yield as a percentage of the gross yield. Why does that happen? Well, multiple reasons. Reason number one, when you do winter wheat and soy, you want to take a bit of the product for recultivation. So some of the product you collect and use them as seeds next year. That's one thing. Another thing, not all of the product is in a good condition that can be sold. So you want to account for these imperfections. And with that, you go to the product you sell. That's the end of the production program. And then you need to go to the cost base of your operation and the economics of your operation. On the cost base, well, that's a little tricky. The idea is, again, we build it on the unit economics basis. So you want to understand what are your variable costs and fixed costs per hectare. In doing so, you want to break down your variable costs and fixed costs into the logical buckets. Like variable costs would normally go into fertilizers, chemicals, seeds, labor, fuel, outsourced services, hired trucks for, let's say, field to storage logistics, and some other smaller buckets. For the fixed costs, that can be taxes, that can be rent, that can be overall SG&A that you allocate to the operation. And then for logistics, there is the cost of transportation, which is called the outbound from storage to the final customer, and the actual storage cost, right? Because the elevators and the grain yards, they require a certain amount of money to operate. With that, you would want to get your numbers, and I hard-coded them here. They are not, well, they're pretty close to the actual ones, but they are rounded up and down for the sake of, let's say, keeping confidentiality of a certain asset. You would normally get these numbers from your controlling or from your controlling or from your accounting team, and that's what usually sits in the ERP system in the corporation. You do that for sugar beet, and then eventually you get into the numbers per hectare. You know what's the price. We'll get to that point a bit later. And you know what's your EBITDA per hectare. Basically, your operating, well, almost your operating profit per hectare. You do the same for the other crops that we decided to grow. One is winter wheat. So you do the same for winter wheat. Same buckets, fertilizers, chemicals, seeds, labor, fuel, outsourced party services, trucks, and the rest, fixed costs, logistics, so on and so forth. And then you do the same for soy. And everywhere you would get your EBITDA per hectare through calculating the total stack of costs and kind of your yield and your price per ton. With that, we can go right back into the economics tab, and in the economics tab, well, basically the only hard-coded input here is a sales price. There is always a long discussion on how do you want, like if you want to take the spot prices and extrapolate them, if you want to inflate them, if you want to do something a bit more advanced for the long-term prices modeling. There is no single answer to that, and honestly, these agriculture markets, they're so volatile that it's usually hard to predict with decent accuracy. So for the sake of the model and exercise, I just did flatlining. I took the more or less actual prices, excluding VAT, for this year, and I extrapolated them till the end of the modeling horizon. In the real situation, you would have a very long discussion with your commercial department on what's going to be the price in a year, in 2 years, and 3 years from now, and a lot of commercial operations and investment decisions would be affected by the prices that you put in here. Honestly, in these agriculture models, prices as one of the most volatile elements, one of the most sensitive factors in the model. Anyhow, you put it here, and it's very easy to convert your output, which we had in the production program, times prices into revenue. And then we know the cost per hectare, since we model the costs, and we know variable costs, we know fixed costs, and we get down to EBITDA every year. And as you can see here, the EBITDA, since we do the crop rotation and we only do one crop per year in the sample model, that's what you get in terms of your EBITDA for sugar beet 2024. That's what your winter wheat 2023 and your soy 2022 and so on and so forth. That's almost the core of the model. And then two things that we want to have. One thing is a little bit of an output which pulls the whole thing together. You would pull the overall arable land that you have, how you allocate your land towards certain crops and the yields of these crops. That's in here, in the yield per hectare. The net yield, where you account for seeds and for certain imperfections in the final goods. The area of arable land, as we say, it's a single crop model. The rotation of the land, the gross product, and the salt product you have. Also the sales price, all in one piece, and the revenue and the EBITDA. It's important to have it here in one place because you would love to, you don't want to jump through different tabs when you have a discussion somewhere in the corporation, but I do strongly recommend to model these three elements differently because you don't want to make your one tab too complex. It's just easier to do it this way, and organizationally, usually it's different departments that are responsible for the production program and for the cost base and for pulling together the economics. So if you send this model or the template to different parts, you wanna make their life easier and your life as well. And then finally, the P&L and the valuation. Let's take a look. The P&L. This one is fairly simple. We already did the economic step, so all I have here, I'm basically pulling it from the output tab, and that was nicely calculated. You go down to the gross profit, and then you go down to your EBITDA, which is equal to your gross profit in this simplified model. Then you want to do account for the depreciation and amortization, and we'll speak a bit later on why there is a DNA in this. Then you get your EBIT, you get your taxes. Luckily, in Russia for crop production, the profit tax equals to 0, so your EBIT virtually equals to your net profit. As simple as that. The second thing you want to do for the valuation is the cash flow statement, where you take the net profit, you add back DNA, you add back the VAT that you pay on investments you make, you add back your change in net working capital, and then you get your operations cash flow. So all of these things basically we modeled before, maybe excluding DNA, which we're gonna talk about a bit later. Then the investment cash flow. You have these numbers here, and by adding up operational and investment cash flow, you get down to the free cash flow. So Where does this come from? Let me show you a little bit below. So for the let's say investments, what are the two sources that you want to account for? One is the actual land acquisition cost. So in this model, let's say the seller offered us to buy 100 hectares land plot for 7 million rubles. It's a fairly decent market price, maybe a little bit below the market now. It's about 70,000 rubles per hectare. And that's what it is. The second thing you want to account for is the machinery costs. Take a look here. For the land acquisition, we just decided to break down the payments into two parts, 50% in 2021, 50% in 2022. And for machinery costs, let's say we do 2022 and 2023. 4 million rubles or 40,000 rubles per hectare. That's very little. That's not enough to buy a tractor or combine or a harvester or any sort of a serious agricultural machinery. Most prices there would start like $300,000, $400,000, so on and so forth. So why is that? The answer is the following. You want to account for a little bit of the machinery in every land plot that you acquire, because eventually, once you acquire a lot of them, you would have to invest into a certain type of machinery because you wouldn't have enough. And it's just wise to allocate parts of these costs already in modeling in here. So once you need to do an actual purchase of a machinery, you already have accounted for that in different parts of land that you acquired in a certain area. Hope that explains. So that's your investment. And how do we break down the investment? We do equity for the land acquisition. Just decided to do so. And for the machinery acquisition, we model equity and debt. We take, let's say, 80% debt, 20% equity. And for the debt, there is a capital structure tab that helps us calculate the interest rate. So let's see. Most of the agricultural machinery loans are subsidized, and therefore the subsidized part would only cost you 2%, which is below the inflation. So that's great, and thanks to the government for having these programs. The non-subsidized debt would be 20%, and here, let's say, we would put 8.75, maybe 9% for the commercial loan. Therefore, the weighted average, the effective debt interest rate would be a little bit below the inflation, 3.4. And yeah, that's your effective interest rate. Now, with the return on equity, it depends on what you put here. There are different ways. In this model, I would say, let's just say the shareholders would require a 15% return on their equity investment. So we just put it here as a hard code. Profit tax, luckily, it's 0. So with that, you get to a cap structure. In the transaction, it's 30% debt and almost 70% equity. And your WACC is 11.2. And what you do then is you take your free cash flow, you run the discounted cash flow, and you do the cumulative discounted cash flow. As you can see, you go into positive in the cumulative discounted cash flow on year 6, right? And then when you look into investment summary, that's exactly what you have. Year 6, the net discounted payback period would be 5.2, and the IRR would be almost 25%. It looks like a fairly good deal, and having something with, let's say, a DPP of 5 to 6 years looks like a fairly decent transaction. So I would say if I had an investment proposal like that on my table, I would probably say, yes, let's do it. Oh yeah, on the DNA. Why do we have the DNA here? Well, obviously, once you buy the machinery gets old, and even though you account for a bit of a virtual machinery in here, you would also want to account for the DNA. So let's. What we did here, we just took simple 10 years straight depreciation, and we plugged it in here. So it will be 200 for the first year, and then about 400 till the end of the modeling horizon. So with the model, that's pretty much it. Hope that helps, and hope that gives you a bit of a flavor on what is modeling for simple transactions in agriculture business.